good morning and welcome to Protecting Intergenerational Wealth, a presentation of our Family Wealth Advisory Group. I am pleased to be joined by a great panel of experienced professionals who will share with you specific client scenarios that have led us to create the Family Advisory Group. I'm quite certain my job as moderator will be a little bit easier than Mr. Wallace's was last night. However, I am going to keep my eye on Jim. Look, our clients often tell us that they are looking for a single source of expertise that can coordinate the financial affairs of their businesses and of their families. I believe, and this is in part due to the fact that accountants continue to rank highly amongst the most trustworthy of professions, that we are well positioned to provide that overall advice and management. In fact, if you talk to our partners and some of our senior partners, they'll tell you we've been doing this in a sort of an informal manner for decades. And it's just recently that we've been able to pull together all of the specific necessary pieces of the pie. I mean, I hope as we work through the fact patterns of our panel that they present, you will recognize just how intertwined the various services are and how difficult it might be to coordinate a group of independent advisors from different outside sources to provide the same level of expertise. With that in mind, I would first like to introduce our fine panel. Our featured panelist is legal expert and certified family business facilitator, Ron Prehogan, president of Equitas Consultants, Inc. Besides his law practice focusing on commercial transactions, including mergers, acquisitions, and the sale of business properties, Ron provides consulting services to family businesses and to business families, focusing on succession planning, communications, governance, and mediation services. Welcome, Ron.
Thank you.
Our next panelist is Jim McConnery. Jim is a tax and estate planning practitioner here at Welch. Jim has wide-ranging expertise in tax, acquired through his 18 years of public accounting experience. Jim provides assistance to individuals and private companies with a particular focus on tax, estate, and succession planning. Jim's clients include companies in a wide range of industries, including many in the knowledge-based high-tech sector. A number of Jim clients have completed successful M&A transactions on both the buy and sell side. The assistance provided has included planning for the structuring of foreign activities and the related tax compliance obligations. The assignments have included an oversight of professional services provided by affiliated accounting firms in various foreign countries. Welcome, Jim.
Thank you.
Carol Lekadir. Since 1983, Carol Lekadir, also a partner at Welch, has honed her accounting and audit skills on audits for various government departments and a wide variety of clients in the not-for-profit, construction, and automotive sectors. She is also involved with the internal management of Welch LLP. Carol is fluently bilingual and works with clients and team members in the language of their choice. Welcome, Carol.
Bonjour, merci.
Finally, we have Sean Kelso. Sean has 20 years of financial statement, audit, internal control, advisory, and accounting experience. He articled with Welch LLP and returned to the firm in 2002, and we're grateful that he did. After spending several years in industry, he is currently the firm's Director of Professional Standards, where he ensures that new accounting, assurance, and professional standards are implemented and executed by the firm's professional staff, assisting audit personnel in addressing complex accounting and assurance matters, and interacting with oversight boards, including CPA Ontario and the Canadian Public Accountability Board. Welcome, Sean.
Thanks very much for having me, Mike.
Okay, first I'd like to kick this off with a poll question. So I wonder, Stu, if you could throw up our first question. So please go ahead and make your choice. Do you have a plan in place to have a peaceful, tax-efficient transition of assets to your heirs? Yes, I have a written plan. Yeah, yes, I have a plan in my head with some follow-up discussions ongoing. Had initial discussions and thoughts, none in place. So please make your answer. And Stu, when you get a second to throw up the results. So none in place, 37%. Had initial discussions, thoughts, 23%. I would love to see that a little bit higher. So I think maybe after the time that we have here today with you, we can convince you that it's probably time to create a plan. All right, with that, I would definitely like to flip it over to Carol, and Carol's got a client scenario which had tons of intricacies. She's worked with this client for a number of years, and I would like for her to start out. Just before she starts, I will say that we are welcoming questions, and we will try to get to them at the end of the presentation. Any question that we can't handle during the presentation, one of the panel members will definitely get back to you. All right, Carol.
Thank you. Good morning, everyone. My story is about the power of having long-term trusting relationships with your advisors and developing relationships with trusted advisors. Welsh started working with this family approximately 35 years ago. The father was in the construction business, and Welsh helped with what we do: compliance, tax compliance, financial statement preparation, help with internal bookkeeping. We'd help with loan applications and everything we do to help business owners run their business so that they can succeed. But after a while, Mr. B, as he got older, realized that neither of his sons would follow in his footsteps, and he had to decide what to do. So he went into liquidation mode. Welsh was right beside him as he liquidated his operating assets and turned them into investment assets. We devised tax-effective exit strategy for him, and then we worked closely with his investment advisors to ensure that Mr. and Mrs. B had many golden retirement years. Welsh also assisted Mr. and Mrs. B with writing their wills. There were several complicated issues at play. One of the sons had moved to the US. The other son had health issues, which meant that the money had been to be kept in trust for him. There were lots of questions about who the trustees would be, who the executors of the will would be, how to best place the money so that it would be secure and that we would have no tax issues with the US. So Welsh was right beside Mr. and Mrs. B as they did all this planning. We created trusts, and we helped them name their beneficiaries and their trustees and their executors. Welsh helped through the estate planning and US tax expertise throughout this process. Unfortunately, Mr. B died and Mrs. B had to move to a retirement home. Neither of the sons lived in Ottawa, so Welsh actually helped Mr. and Mrs. B and the sons find a proper retirement residence. So not only do we help with tax, we also try and help with life issues when we can. And this was very much appreciated by the son. Today, Welsh is the accountant for both sons, who have branched out into their own businesses. We still have a very close relationship with both sons and with the investment advisors who were the initial investment advisors from the beginning. The sons rely on Welsh for the same things that their parents did. During all those years, Welsh was part of a network of specialists supporting the B family: the insurance agent, the lawyer, the investment advisor. We were lucky that even though we all worked for different firms, we could all get together for the good of our client. There were a lot of meetings around tables, in restaurants, in people's homes, so that all the advisors could come together for the best of the client. But I'm thinking, what if we all worked under the same roof? There would be so much more sharing of information. I think the client would have saved money over the years because of not having to duplicate information. And sometimes if one of the specialists had to leave or transition out for some reason, it was difficult to find somebody that we could trust to enter the group. So if everybody had been under the same banner, the transition would have been a lot easier. So I think that having everybody under the same roof would have led to more efficiency and consistency over the years. Even though this was a big success, I can see that it would have been a lot easier if we had all been working under the same banner.
Carol, why did Mr. B pick you or pick Welch as sort of the quarterback for all of this? So presumably he had lawyers, he had insurance agents, he had investment brokers, he had people helping him liquidate his assets. How come he turned to you?
Well, I think in the early years, there was a lot of trust built because I think that is a normal thing, is to trust your accountant. So over the years, there was a lot of trust built on a business side and a personal side. So whenever important life decisions had to be made, he would automatically turn to me because he trusted me, he knew that if I didn't have the answers, I had somewhere to go to find the answers for him.
Yeah, and I mean, I can certainly remember sitting in on a couple of meetings with Mr. B, and you could see that his trust in you was significant. I might say something, and he would look at you and say, "Well, do you agree with him?" So it was obvious. Yeah. I wonder if any other panelists have anything to add to that.
I'm going to comment, and I often get the opportunity to work with Carol and her clients. And one thing that resonates for me, and Carol, Michael is right, that relationship aspect that you have with clients is so valuable, that trust builds and accumulates over time. I think separate from that, though, is that historical type knowledge and insights. You and I, Carol, sometimes have a discussion about a financial or a tax matter, but I can appreciate that the client doesn't really understand why ABC matter is relevant to their planning. I can imagine as well that would get lost in the mix if they're dealing with a new advisor and that advisor is not aware of something or planning aspect that was put in place many years ago. So I think that connection that we build over time with clients is very valuable, but it's also that fundamental understanding and expertise about what can be complex financial and tax affairs.
Mm-hmm. And I think there's a big element of trust too, is that sometimes business people can feel lonely because they don't have anybody to bounce their ideas off of. They need somebody that they can call and just discuss matters, whether it be on a contract or on anything. They just need somebody that they can talk to. And with that, with repeated help, I think a great relationship builds.
And as complicated as that scenario was, I mean, it could get a lot more complicated if maybe one of the boys does want to be in the business and the other son doesn't, and how you manage around that. And maybe, Ron, you have some ideas about how you sort of equate all that.
Sure. First of all, thank you, Michael, for having me on the panel. Yeah, that's a common type of situation where you have, perhaps one child who's interested in the business, another who isn't. There's the issue of competence. There's the issue of, does the patriarch or matriarch of the business really know what the kids want? And so, yeah, you can have all kinds of situations. Some of the ones that I like to get involved with are the proactive ones, where, as an example, with a patriarch who has several children, he really wasn't clear about which of his children really wanted to take over. I think they were telling him what he wanted to hear, not necessarily how they felt. So sometimes I will get involved in a situation like that, where I will meet separately with the children and go back to the patriarch or the matriarch and provide a report. Here's what your kids are telling me that they want. So yeah, there's all kinds of situations.
Yeah. So just to keep things rolling, I think maybe I'll turn it over to Jim. Jim also has a fairly intricate scenario that he could share with us, and we can kind of pick at that one a little bit as well.
Thank you, Mike. I'll talk maybe about two different types of client scenarios that we see at Welch on a fairly regular basis. I think they're relevant to the audience and the people who are listening. And the first would be that notion that people do very basic estate planning, and they're doing it in a way, I think, that they're trying to check the box, that they've got a will in place, the will is up to date, and it addresses what would happen if individuals died. I sometimes play a game with clients that I ask them if they have a will that is up to date. They'll often tell me that they're not sure, they think maybe. Eventually I normally get a copy of the will, but before I get a copy of the will, I can normally tell a couple how their will reads. And I tell them that upon the death of a first spouse, all the property of that spouse goes to the surviving spouse. Upon the death of the surviving spouse, all of the property is left equally to the children. And that's often a very common scenario, and I call that more or less a template type will It's a template type estate plan. It's providing a framework for the distribution of family assets and family wealth. I think it's tenuous if that's connected to a corporate group, a business group, but let's leave that aside for now. But the fundamental concern and problem is that there hasn't really been a meticulous analysis or planning for the family wealth. It does create the comfort, I believe, from let's call it mom and dad, from their perspective that they control the wealth for as long as they're alive. That pool of wealth is available to them, it meets their needs, and they have ongoing control. The problem I see is that often that planning is static. It stays in place for a very long period of time. Let's assume that dad dies first when he's 75, all the property goes to mom. And then let's assume that mom has an issue like Alzheimer's or dementia. She's no longer in a position to do any planning around that family wealth. And now you might have that pool of asset value in the family group more or less stuck. It might stay as is until mom dies, perhaps in her 90s or older. And you have a scenario where that family wealth will sometimes skip a generation. Mom dies when she's 90. Her kids are perhaps now in their 50s and 60s and they have their own wealth. So it's really generation 3 that will benefit from that family wealth. I think that's okay if that's the fundamental goal and the fundamental plan for the family group. But I think it's often happening just by default without some meticulous thinking about the family wealth, what it means for the family, and what are the options to transfer that wealth perhaps earlier instead of holding on for as long as possible. I think in part it includes the concern of a couple saying, do we have enough wealth to meet our needs on a long-term basis? The answer sometimes is we're not sure, and that becomes the default. Well, let's hold on to this entire pool of wealth. Let's defer the transfer of wealth. Whereas some analysis might be the case that there's more wealth than they're ever going to need in their lifetime, and they perhaps want to accelerate that family transition of wealth. Ron, I expect you probably have some insight on that type of scenario and related input.
Yes, I mean, it's a truism in the succession planning field that the earlier you start, the better the result will be. I find that a lot of people, and I'm sure that all of you experience the same thing with your clients, people tend not to want to tackle these issues. As I often say, a person usually doesn't wake up in the morning and say, geez, I want to get my will done today. And it's the same thing with any type of succession planning. Often there are barriers to doing so. There could be family issues. There could be, that one child expects that he or she will be taking over the business one day. And that's not perhaps exactly aligned with what mom or dad had in mind. So there's no question that the sooner it's tackled, the better. And often it requires professionally facilitated discussions, because to have these sorts of conversations without that, what tends to happen is people just repeat the same patterns of conversations, especially often between siblings, where issues can arise and they just seem to go in a circle and never seem to get out of that circle.
Mm-hmm. Yeah, it seems to be human nature to just put off those tough decisions, right? So it's not imminent, so why do I need to make that decision now? So you just, like you said, you just don't wake up and say, oh man, I really want to tackle this nasty thing right now.
Yeah.
Yeah. I often provide the feedback that I'll say status quo is definitely an option, right? That mom and dad hold the pool of wealth and they're going to hold it for as long as they're alive. And that, that's more or less status quo. It's an option, but it's maybe not the best option. And there probably is an avenue to explore the options, understand the implications. And back to your point, Ron, it gets into a family discussion about wealth, which I think is important. In a lot of cases is probably avoided, right? It means the groups are maybe stuck with status quo, which in some scenarios can be problematic. I was going to comment on a different scenario, and now I'm thinking of a business owner client. I think men and women can both have this approach, but I'd say it's probably more common for a male business owner. And maybe it's that lack of comfort around communication and discussion around what could be emotional family type matters. But it's that fundamental concern that I can have a business owner client. There's a valuable corporate group. The business owner owns the corporate group, and the business owner wants to arrive at a plan for the transition of the ownership of the business, which should include some important considerations around succession planning, tax planning, financial planning. And what I see once in a while is that business owner client wanting to have a plan that is, I'd say, primarily tax motivated. It's looking at the steps to minimize the tax on the transition of the business. And it sometimes includes the caveat for myself, for perhaps the accountant, the Welch colleague who is helping with financial statement reporting, the lawyer, but it's that fundamental constraint that this is confidential. It's the business owner's plan for the transition, for the succession of the business, but it's not to be shared with family members. It's not to be discussed. And I think that in some cases is some comfort for the business owner that they're fully in control. They get to decide. They don't need to cooperate with other stakeholders in the family business. And maybe also the peace of mind that they can get this plan in place relatively efficiently. But I see that as a really tenuous type fact pattern. In an ideal scenario, everyone gets along and that plan that is kind of mapped out on paper eventually gets executed and everyone is fine with the plan. But I think there's a significant amount of uncertainty, including that the business owner is probably making some key assumptions about the various stakeholders and that the plan put in place will meet their needs and that they're fully cooperative. And I think on the other side of the coin, it's probably missing an opportunity to have a more proactive exercise, which presumably can be time consuming, but it can involve important discussions, but presumably that proactive exercise leading to a better fundamental plan. So that concern, right, that a business owner might have a structure, a plan in place, it's confidential, and maybe there's real skeletons in the closet, which will become an issue down the road.
Ron, could that lead to someone contesting what's been put in place or no?
Oh, absolutely. As Jim was saying, sometimes that works, but I would say that it's in the rare case. I could go on and speak for the next hour about different situations that I've had.
I don't want to have to stop you now.
Okay. I mean, it really, the problem with it, I mean, usually the reason why that is done is because the patriarch or matriarch really doesn't want the family to know how valuable the business is, how valuable the assets are, because they're worried about perhaps that'll make the children lazy or greedy. And these are all valid concerns. But there are various ways, to get around that. And it starts with communication. I'll just give you one example. I was hired by a widow. Her husband had died, leaving significant real estate assets, and she had all of the voting shares, and her sons had non-voting equity shares. And when she approached me, one of her sons had already hired a lawyer and was basically accusing her of fraud and was about to commence a lawsuit. So this was a situation that I stepped into.
Wow.
Fortunately, we got it resolved. I started working with the other lawyer and I called a meeting of the board. And it was clear that there was just obviously, you can't have a close relationship with your mother if you're threatening to sue her.
Yep.
But they came into my boardroom, we all sat around the table. They hardly looked at each other, which was very sad, obviously, but that meeting eventually led to a resolution of the situation. So the mom now is thankfully freed of her voting shares, which were like an albatross around her neck. And the kids have what the kids want and need, and everyone's good. Unfortunately, family relations are still horrible, but at least we brought about the separation that was required.
Yeah.
Ron, on that point, an interesting dynamic from a legal perspective that the lawyers can be representing different parties. Never thought about this that much before until the last few years, but in that scenario you describe, there could be a lawyer at the table who's acting on behalf of the corporation, a lawyer acting on behalf of mom, and then a lawyer acting on behalf of the kids, right? Which gets to be a pretty tenuous and perhaps adversarial type scenario. And then the view that maybe that could have all been avoided if dad had a more proactive plan in place that everyone was on board with, and that was the subject of discussions, right? But you'd imagine the lawyers would love that type of adversarial type scenario where there could be a big fight that drags on.
No, that's exactly right, Jim. In fact, the cases that I get involved with are either at the early stage where I'm helping with the succession planning, or at the later stage, like in this example I just gave, basically keeping the parties out of court. I'm often the last resort before everyone going to get lawyers and with all the horrible stuff that entails.
Mm-hmm.
I wonder, Jim, is that, I think that's your segment, or have you got more to add, Jim?
No, those were the two types of client scenarios, but it was describing that concern, right? That people sometimes don't really have a meticulous plan in place. They've done the bare minimum, and that's, you know, may subject to issues. And then that separate type of scenario where you've got a business owner type client who hasn't been engaged in an active exercise to plan for the succession of the business and all the concerns and issues.
Yeah. I wonder, Stu, if we could do our second poll question right now. So having been through these scenarios, these two scenarios so far, are you feeling comfortable with your current plan? Are you worried about your lack of plan? Are you going back to the drawing board? Take a couple of seconds. Thank you. I have seen a few questions coming in, and I've been trying to respond to them as we go along. And I might ask the other panelists to check from time to time on the Q&A box down at the bottom and see if they could answer the question. All right. Well, that's good. That's good to see that. Well, I guess not. They are worried about their lack of plan, and they are going back to the drawing board. So it's a small percentage that's feeling comfortable. So yeah, it's a tough thing. And I think the best scenario might be the one that's coming up from Sean, because it's an opportunity where we get involved, as I recall it, Sean, very, very early, and kind of provide our whole spectrum of services to the end. So maybe you could walk us through that, Sean.
Sure, thanks, Mike. Yeah, we're currently helping a client through that very matter. We talked about the reluctance to maybe have people examine their wills, and sort of a concern about doing that, and sort of something that they want to put off. Oftentimes we see that with key assets in a corporate group. So a lot of times our clients, the companies are really their life's work, something that they've really produced from the ground up. It's a source of pride, but it's also presumably in many cases their primary asset that you need to leverage in retirement. With they can't transition the business in a family scenario. They may inevitably look for a plan to sell that business and monetize that asset. And again, you're caught up in the day-to-day, and you're dealing with strategic matters or operational matters, and that building that plan to sell is sometimes something that's put off. So we've been working with a client group to inevitably their exit will be by way of sale, and they're really trying to put a plan in place. It's something that causes anxiety and stress, because it's such a significant asset, and trying to figure out a plan to execute a sale is really important. And you don't want to be scrambling at the last minute when you're in poor health or circumstances maybe put you in a must-sell scenario. So you want to be in the driver's seat. You want to have your plan in place, and you want to do things that you can do to really enhance the value of your business and be proactive in that regard. So what I really like about our offering is we really have a lot of the team in-house. And Carol talked about the fact that, yeah, we can work with other advisors, and we work very well with other advisors. But in terms of working through this scenario, really I'm working with my colleagues. We have the same infrastructure. I encounter these folks on a regular basis. So the transfer of information is very efficient and fluid. And really they're my friends. So it's there's a lot of trust in the relationships as we work through the issues. So it starts with helping the entrepreneur decide what's the value of my business. How much could I obtain through a sale? What's my business worth? And then it's, okay, what can I do to enhance the value of my business? So again, not doing it at the last minute or when you're forced to sell, but really taking steps to, get your business ready for sale, just like the preparing your house for a showing and that type of thing. It's the same concept. What can I do to make my business more valuable? So again, we leverage our colleagues in the Welch Capital Partner Group to provide that kind of insight, and they're helping determine what this business might be worth in the marketplace by way of sale. So that's very useful. I can leverage my tax colleagues when we do obtain the proceeds. How best should we go about it? Again, is it possible for an asset sale or would we, or a share sale? Could that be achieved? That would be a great outcome if that can be accomplished. And then when we accumulate these proceeds in a tax efficient way, what's the financial plan for retirement for this family? How are they going to, basically invest the proceeds and obtain the cash flow that they need to finance their retirement? So having a plan really reduces the stress and the anxiety. And again, I think the complement of services, the team that we have, will really allow us to have that plan in place. Everybody's comfortable with how it's going to be executed. And then we leverage, the lawyer that's going to help them when we go to the time to execute the sale and the purchase sale agreement and other legal aspects of the transaction that will be inevitably arise. But the plan is there. It's ready to go. There are different scenarios that we can pursue depending on what the offers are on the table, but everyone is comfortable that they have a vision as to how it's going to be executed. And I think that peace of mind is invaluable.
Yeah, so that's a great scenario. So that's a client now that we do recurring work for, like we do on a regular basis. We've developed a strong relationship with the client, and now he's coming back and saying there's a bunch of things that need to take place over. I want to get out of my business ultimately, and so we can provide a number of services. And I don't think we should downplay the fact that many of our clients come to see us to think that their small business is worth a certain amount of money, and that once they sell it for that, it'll be an easy sale, and that they're going to live off the proceeds. And they don't always realize that maybe their company's not really ready for sale just yet. And I think that's a big part of helping someone with the transition, is saying, look, yeah, we can do a fire sale and we can get you out of this business pretty quickly, but you really want to maximize your value in there. And that's when we, move to the Welch Capital Partner guys and say, hey, what do we need to do to this business in the next 2 years so that this individual can really maximize what the proceeds are? So yeah, and that's, once again, it's like an in-house, as you said, we walk across the hall to our friends in Welch Capital Partners, and we're confident that they have the tools and they'll be able to figure it out. The other side of it is, at the end of the day, once, and let's face it, these small businesses are taking a ton of risk, and they're building up their value with a high risk environment. So when the time does come to cash out, they really want to be more in a safer environment. And I think that sort of rolls into our wealth management side of it, and the methodologies that we're using, our partnership with Purpose Investments as to how we invest the money so that it's there when they need it after the fact as well. And then, of course, the tax. I mean, there's a ton of tax work involved. I guess the other thing we should point out at this stage is that as much as we can do the big part of it, we are not lawyers and we can't do the legal work, and we rely on individuals like Ron and Ron's firm to sort of dot the I's, cross the T's, finalize it, and make it work in the right way. I don't know, anyone else might want to comment on that.
Yeah, Mike, I think what you guys are doing is fantastic. Really, I think for a couple of reasons. One is, otherwise clients tend to have to manage their professionals, to spend a lot of time going from one to the other. So there's the time factor for the client. There's also the risk of things slipping through the cracks. right? If you're going to this one, maybe that professional doesn't know what the other professional advised. Maybe the client is getting conflicting advice. By doing it this way, I think you guys are really way ahead of the curve on this, and it can only work to the client's benefit, in my opinion.
Yeah, and I mean, I would like to say that we're the first to do this. I mean, this is something that maybe we're on the leading edge in Canada for sure, but this is certainly going on in the U.S. and many mid-sized CPA firms in the USA have developed this type of strategy to offer up all the services at the same in the same house. So, and anything more from you, Jim?
Mike, and it's related to our discussion. I think the question was chatted in. I think it's a great question, is sort of what are the fees that apply for this type of work? And I think the key is to understand exactly what the nature of the project is, what we're trying to help a client with, what solution does the client have in mind. And I don't, and I'd advocate, and speaking for Welch and other organizations, that an individual that needs that detailed type of financial estate succession planning, that they really contemplate the various options that are available in the marketplace and try and get a handle on what the deliverables are, what support they get, and then what the fee arrangements are. And I have a lot of respect for lots of different advisors in the marketplace, but there's so many different types of solutions that are available. I think at Welch, the key approach that we'd often have is to identify really what the deliverables are. If it's estate planning, succession planning, that starting phase might be really a vetting of, what the planning issues are, the planning matters, the planning options. And phase 2 is probably implementation, but it'd be very fair for a client to ask for clarity around the fees associated with that exercise. And I definitely advocate, if anyone's dealing with other advisors, to ask those same sort of questions, be really clear on what the deliverables are, what the fees are. And then I often think of it as a two-way street. It's a great opportunity to hold your advisors accountable to a timeline, but that two-way street is the clients have to be accountable to a timeline as well. So I often see an estate planning exercise that will start, and 2 years later, we're still at square A. But sometimes that's the client not being ready to tackle some tough discussions or some tough decisions. So it can be a complicated process. There's lots of different advisors who provide different types of support, but definitely it's good for a client to do their homework, understand what the support options are, and understand the fee arrangements and what the deliverables look like.
Jim, I think there would be a situation where I've been, I was mentioning how we want to develop some kind of a relationship with the client where we feel we're a trusted advisor. We don't want to be in a position where the client feels nervous about picking up the phone to call us, to talk to us. So there are arrangements to be made for some kind of a base fee structure where the client can pick up the phone, set up a meeting, have lunch, and not be nervous about being billed for every time they try and talk to us. So I think that's very important to build trust and build consistency and long-term relationships. So that's something we can look at also.
I agree.
Yeah, and one other thing, Jim, another great question. People are concerned about, so our government has spent all this money this year trying to keep the wheels turning in our economy, and it's almost impossible to think that moving forward we're not going to see some tax increases. Often when people start talking about tax increases, they're talking about the capital gains inclusion rate, the top marginal rate. What are we advising our clients right now? Should, certainly if someone is considering sort of the estate freeze or those sorts of things, is now the right time to do that? If there's going to trigger a bit of a capital gain, should they be doing it now? What's your thoughts on that, guys?
Yeah, maybe I'll answer first, and I expect the other panelists have insight as well, but it is a great question, Mike, and it's a big area of concern because we've had a tax regime in place for a number of years that's been relatively static. For a significant number of years now, we've had a 50% inclusion rate on capital gains. We've had marginal tax brackets that have gone up a bit over time, but a regular corporate tax rate or a regular top personal tax rate around 50%, which translates to a tax rate of 25% on capital gains. I think there is a concern that at some point in the future, Is it 2021 or is it later? And it's the governments who will be struggling with ongoing deficits and need to generate additional revenue that capital gains rate is subject to increase. I think a very quick fix is for the capital gains inclusion rate to move from 1/2 to 3/4. There's some fundamental reasons why that makes a lot of sense, but that would take your capital gains rate from about 25% now to somewhere 37, 38%. So on that point, Mike, I've not been a fan in the past of crystallizing and paying tax on a capital gain today that could be deferred, but it is a valid point of concern that you could have a higher rate on capital gains in the future. We will often as well have a personal balance sheet for a client. We have an itemization of all their assets, an estimate of fair market value, an estimate of cost. We know what the gain would be if they die, and we can estimate that tax based on the current capital gains rate. That amount is going to go up by a material amount if the capital gains inclusion rate moves from 1/2 to 3/4. Not the point of our discussion here, but there is a concern as well. Would the government ever claw back the principal residence exemption? That for a family group is often a very material pool of wealth, which is tax-free. So a lot of uncertainty on a go-forward basis, but I definitely expect that if anything, the rates on different types of income are going up and not down. Does it happen in 2021 or later is to be determined, but it definitely is a concern from a financial planning perspective.
Jim, maybe you could talk a little bit about the lifetime capital gains exemption. I think that's a big opportunity for a lot of our entrepreneurs. And do you see that as maybe being threatened, or and maybe what the level is today of the capital gains exemption?
Yeah, that's a great question, Sean. From a tax planning perspective, sort of the best scenario you can have is realizing a capital gain. That's where you get the most favorable tax treatment from a rate perspective. And then the very unique category of capital gain where you get the best treatment possible is the capital gain realized from the sale of an active Canadian business. The $900,000 of capital gain can be tax-free via the capital gains exemption. That exemption also extends to qualifying farm property. It extends to fishing type assets as well, which is not a big part of our economy in Ottawa, but often a gain from the sale of a family farm. But what's more common for Welch clients is a gain being tax-free by virtue of the lifetime capital gains exemption. A current limit, Sean, of 900,000 about, which is indexed, it goes up a bit every year. My take is that is not going away. I think it's seen as a fundamental support for the private small business community in Canada. It would be a very unpopular measure if the government one day proposed to repeal that measure. So I think it's here to stay. And it would be worth even more if today it's worth about $240,000 in tax savings based on our current capital gains rate. The savings would be even more if instead we had a 3/4 inclusion rate. And just a comment on the principal residence exemption, I've had clients ask me, and I assume they're reading stories in the media that the exemption could be eliminated or clawed back. And then the question becomes, what can I do to lock in the exemption today, right? And it becomes a bit tough that you'd have to somehow crystallize a capital gain. Maybe that's transferring the ownership of a home to a corporation which has issues, or to a family trust. But that's a concern. And I think from a government perspective, they're saying, it's fine that that gain is tax-free, but if someone in Vancouver has a $5 million capital gain from the sale of a home, should all that capital gain be tax-free? So would, the speculation is there could be some ceiling on the amount of gain from a sale of a home that is tax-free.
Jim, one thing about the gains exemption, though, it is possible to crystallize it, and you don't lose access to it going forward if it increases. You can go back. And so if you are concerned that maybe that is something that's on the table, or it'll be clawed back or reduced, then crystallizing, there are some professional fees to do it, but it also locks in that new value. So something to consider.
Yeah, and it would be a good avenue for clients to examine. The clients understand that option, that they understand the implications. I've not been a big advocate of crystallizing in the past, but I can see how the framework on a go-forward basis is different. And adding to that, Mike, one scenario that can be an issue is that you could have a business that qualifies today. The capital gains exemption would be available to offset a gain, but for various reasons, the business might not qualify in the future. So it'd be very prudent for a business owner to understand that framework and maybe get a bit of guidance. I could think of scenarios as well where a business owner assumes that they will realize a gain that will be tax-free by virtue of the capital gains exemption, and based on a review that we might do or another advisor might do, we can tell them that they're not on side. The good news is that they can really do things to get back on side, but that would be problematic if they discovered that issue a month before a potential sale. So it's definitely an area where proactive planning makes a lot of sense.
Yeah, it's almost like constant surveillance. Keep your eye on it and manage the rules. Ron, there's a question there about indicating that most of us have our wills and some of us just need to be a little tweak rather than a complete rewrite. Is that possible? Is that something that makes sense?
Absolutely. You know, if there is a specific part of the will that needs to be changed, for example, you know, naming your executor, or perhaps someone would like to add another individual as a specific bequest, that can be done by way of what's called a codicil, which is a very short form document amending the will. Depending on the situation, oftentimes, if someone has not done their will in many years, we encourage them to do a new will. The cost often isn't any greater than doing a codicil, because we're taking our current form of will, which is based on current tax laws, and we're providing that, in effect, if you want to call it that, free of charge, compared to a codicil. People often think, well, it's cheaper, I'll just get a codicil done. And sometimes that's true. If it is, as I say, something very, very specific, and if it's a properly tax structured will, then it would work in that case. But as I say, in a lot of cases, we'll find, you know, someone hasn't done their will in 15 years and they say, you know, should I, you know, I just want to change this and change that. Well, we strongly encourage them to have a new will done.
Yeah. Yeah. And how often should that take place? I've always thought maybe 5 years or 2 to 5 years is a good review period.
We always tell our clients, a letter goes out after the will is done. We'll check back in with you in 5 years, and we have it all set up that way. But we also say that if any significant event occurs during that 5-year period, it's very important that you reach out to us. So just to let us know, it may not require an amendment to the will, but it might also require it for tax or other reasons.
And just one more question for you with respect to freezing. So general background being that I've created a certain amount of wealth in my company. It's probably more than I will need for me to move on with. I know that as it goes up in value more, I'm creating more tax bills. So the theory is, well, let's freeze that value right now back to me as the sort of the main owner, and then let's involve another generation. Do I need to worry about losing control? Do I need to worry about, you know, somebody coming from the back door and taking what I've created? Or is there, no, okay.
No, you don't need to worry about that, because the way to set up the freeze is ensuring that the voting shares continue to remain with you in that example.
Okay.
I would comment as well on that point. You know, from a tax perspective, if you outline the framework on paper and you understand the pros and cons of a freeze, I think the downside to a freeze is pretty limited, including the notion that as the business owner, so let's say Mike owns a company, Mike owns 100% of the common shares, Mike could do a freeze, basically convert that common share value to fixed value preference shares that are voting, Mike still controls. A family trust could be the new common shareholder of the operating company, and Mike could be a beneficiary of that family trust. So the freeze is sort of that scenario where you can lock in the value held by that particular individual. All the future value is accumulating for the benefit of the family trust. But in my example, by including Mike as a beneficiary of the family trust, Mike could have access to some of that additional value if he wants. So, you know, I call that a reversible freeze. but the notion that it's giving you a great planning scenario with lots of flexibility on a go-forward basis. I've seen it once in a while, you know, and just using round numbers that I can talk to a business owner client, they'll tell me they think their business is worth 2 million. We contemplate the merits of a freeze. You know, we can estimate the tax that would arise on $2 million of share value, let's say 500,000. They don't do a freeze, and we have a discussion a few years later, and now they say the business is worth 5 million. And I said, well, it's the same discussion. You could do a freeze now, but now we're going to freeze at 5 million. And now you've got an extra 3 million of value that you could have frozen that you didn't freeze, and that's fine. But that's an extra 750,000 of potential tax stuck with that original business owner, whereas that family trust would have given us more latitude.
By the way, another benefit of the freeze, just tying back to our earlier discussion, but sometimes you have children who are in the business and creating value in the business going forward, and other children who aren't. And oftentimes when the parent is doing planning, they want equality for the kids. What I find is often a good way of approaching it is to say these growth shares, you know, set it up exactly the way Jim was saying in a trust, but you benefit with the growth shares those children who are active in the business and adding value going forward. And then as far as the free shares are concerned, those you can divide up equally amongst the children, even those who aren't involved.
Ron, it appears that the questions that are pouring in are addressed primarily to your understanding. One of the questions is, what's the reasoning or rationale for multiple wills?
That's really all about reducing probate fees on death.
Okay.
If you have just one will and covering all your assets, then you'll be paying, I think it's 1 3/4% probate fees. The estate will be paying on that. By having two wills, what you're able to do is to remove some of the assets out of the primary will that are not subject to probate. So basically, it just allows, in a lot of cases, a significant reduction, especially as an example, if most of the wealth is tied up in shares of a company. By putting that into a separate will that is not subject to probate, it can often almost eliminate the probate fees if that represents the great bulk of the value of the estate.
And a similar question here is, so I have assets in 2 different countries. Is that a requirement for multiple wills? Should I have a will that covers each of the countries?
Yes. Now that's a different kind of multiple will, but absolutely, it's important if you have assets, especially real estate, in a foreign jurisdiction, you definitely want to have a will in that jurisdiction. It's helpful. It's not absolutely necessary,
Yep.
but it's often helpful. Certainly, at least get the advice on that before assuming that you necessarily need it. But yes, in a lot of cases, that's a good idea.
And one last one, the individual has named both their sons as executors, joint executors of their estate, but one of the sons lives in the U.S., I guess as a resident of the U.S. Is that a problem for a Canadian trust to have a U.S. executor?
Well, not to have a U.S. executor, as long as there is, as long as the U.S. executor or executors do not have control of the estate. Okay. That's the key. So I think in the example that was just given, if you have one, say in Canada and one in the U.S., then by naming them both, I think you're okay in that case. But obviously, check with your advisors.
Yeah, gotcha.
On the separate concern for that U.S. individual, by virtue of them being executors of a Canadian estate, they might trigger some U.S. reporting requirements because Absolutely. They control an underlying estate, and the U.S. basically hates an entity that is non-U.S., so a foreign estate could trigger some IRS reporting requirements because that U.S. individual is an executor. If it's feasible, yes. Excluding that person as an executor would avoid that reporting dynamic in the U.S.
The other problem with having a foreign estate, effectively that's what it is that the executor would have to post a bond here that can be very costly. Wow. And there are also issues dealing with if the investments are here in Canada, that can be problematic as well to the, say, to the bank to have a foreign executor. There are a ton of reasons why if you have a foreigner who you want to as your executor, absolutely get advice. And the laws change on this all the time.
Yep. And I even think, Carol, that was an issue with our friend Mr. B. Listen, I think we're going to have to wrap it up. It's been a great session. I think we have one last poll question to put out there. I wonder, Stu, if you could throw that up. So does the concept of family estate planning overwhelm you? And it's again, a multiple choice. No, not at all. I find it hard to get started, and I will be looking for advice. So go ahead and answer that, please. While that's taking place, I really want to thank the panel members. I think it's been a great discussion. I hope, or I suspect, that some of the things we've talked about today have maybe given you some food for thought, and you might want to go back and analyze your own situation a little closer. There will be a brief. So here's our answers. So not at all. So that's a good sign. 43%. Hard to get started. 26, and we are looking for. I think that sort of would be the numbers that I would suspect or expect in a poll, something like this. But anyway, I want to thank everyone for joining us. I think we're going to have to wrap it up. I do want you to know that the next webinar in this series is November 17th, and it's going to be a sort of a broader view of the markets based on the outcome of the U.S. election. So please join us for that. And I think as Stu wraps this up, he's going to post a final survey question for everyone. So once again, thanks to all the panelists. Thanks to you for joining. I hope it's been helpful, and we'll see you down the road. Thank you.
Thank you.
Thank you.
Thank you.